Money on my mind, looking for a dime. James Locke in the house, gonna help you shine.
Welcome to the Poole Locke YouTube channel. I'm James Locke. Today we're going to answer two more Ask James questions of the day. First question from William. I'm worried about volatility, but I still want growth. So where can I find it in the stock market? I don't know, William. You might have FOMO, right? I've mentioned it before. William, you might feel like you need to get more growth. Maybe your portfolio isn't as high as you'd like it to be. You need to have a bigger number before converting to income. So, William, if it's FOMO, if you just don't want to miss out on stuff going up, then I would say you need a therapist, right? Or that might be a good recommendation because I'd rather have you kind of shake that, right? If you're looking for a thrill, you want to feel the excitement of the stock market going up, go ride a roller coaster, right? Great thrills, and it doesn't cost you a lot of money. However, if it's truly, right, I'm joking, right? But if it's truly that you're trying to hit a bigger number, if you convert to income now, like I've told people before, and it's not quite enough income to retire on, well then, okay, maybe you do need more growth. So the first basic answer is to get into higher dividend value stocks. Higher dividend value stocks, if you pick the right ones, can give you more downside protection because they're value stocks. So their lower price to earnings ratios are typically considered to be more undervalued and certainly not overvalued like some of the growth stocks. And they pay dividends. So as long as, you carefully pick out the ones that are good dividend, have good dividend histories, that might be a good way to still be in the game to some degree, but also making that transition, right? Now you might say, well, that's great, but in a recession, a lot of those consumer stocks and things like that, they're going to be affected by recession, consumer stocks. Well, okay, point well taken. You have to be careful because consumer stocks or discretionary stocks aren't going to do well in a recession because companies might just say, well, we don't know what our profit is going to be. They're going to be, it's going to be a lot less. That could actually hurt, right? Another approach you can take is maybe do it with more of a barbell strategy. Barbell strategy meaning where you have the extremes, right? You got the conservative defensive stuff on one side that might actually do well in a recession and the more growth-oriented stuff on the other side. So maybe, now we had a pullback, in all that artificial intelligence stock valuation, maybe putting some money in those, right? I wouldn't say 50-50, but if you put more than half in defensive and less than half in the growth, that barbell strategy, with kind of opposites might just pan out and might give you a bit of a hedge also, right? Because again, right now the biggest issue is we don't know. We don't know whether we're going to stay the course with these tariffs and end up really causing our own recession or whether we're going to change course, right? And use it as a negotiating tactic to, or have a plan, as a country thing, right? When this is going to get back to normal and maybe it was just 1 month news blip, right? Now let me also mention a few specific sectors that might help you kind of thread this needle between growth and income. Healthcare, particularly larger pharmaceutical companies, often combine decent dividend yields and growth potential due to an aging population and continual innovation. Now, many of these firms pay 3-4% dividends and still offer growth opportunities, especially in specialized treatment areas. Infrastructure, an infrastructure play is another area worth considering. With the kind of ongoing focus of infrastructure development, companies involved in utilities, telecommunications, industrial REITs, they can provide steady income while participating in long-term growth trends. So these can be particularly attractive as they tend to have more predictable revenue streams, even during economic uncertainty. Now, don't overlook the potential of dividend growth investing as opposed to just high current yield, right? Companies that consistently increase their dividends year after year, even if starting from a lower yield, can provide both meaningful income growth and share price appreciation over time. This approach allows you to gradually transition from growth to income without making a drastic portfolio shift all at once. Bottom line, protect yourself, William, right? Keep yourself protected, right? Thanks so much for your question here. Remember that balancing growth and income doesn't have to be an either-or proposition. With careful selection, you can build a portfolio that addresses both needs while still helping you sleep at night during those volatile times. It's a great question. If you'd like to send in your question, you can do so. You can email us to poolelock@poolelock.com. Let's move on to our second question from Brandon. He wants to know, how does investing for income actually help with inflation? All right, Brandon. Insightful question, concerning how investing for income can really help combat inflation. It's an important topic, and let's dive deeper into why income-focused investments can indeed serve as a hedge kind of against inflation. Well, when inflation rises, central banks, like the Fed, typically respond by either increasing interest rates or maintaining them at higher levels for extended periods. So this was evident recently when the Fed's policy stance suggested a prolonged period of higher interest rates, leading to an immediate uptick in yields on government bonds, such as the 10-year Treasury. That's what we always kind of look at. Now, why does this matter for investors seeking income? As Warren Buffett famously said, if you can borrow from someone, you could borrow from Warren Buffett, right? Like when interest rates, I love listening to Warren Buffett. He's great. But so essentially when interest rates rise, he says the value of all financial assets tends to decrease, right? However, the impact varies depending on the duration of the investment. Duration in finance refers to how long it takes for an investor to recoup the investment's price through its cash flows, right? Taking into account the present value of future cash flows, right? So here's where investing for income comes into play. Income generating investments, such as bonds or dividend paying stocks, provide regular cash flows in the form of interest or dividends. So these cash flows act as a buffer against the negative effects of rising interest rates. So assets with higher income streams relative to their price, known as shorter duration assets, are less sensitive to interest rate changes compared to longer duration assets, which rely primarily on capital appreciation. So for instance, a bond that pays a 10% annual interest rate effectively shortens its duration because you receive a significant portion of your investment back as income over time. This reduced duration means these investments are less vulnerable to the immediate impact of rising interest rates on their overall market value. Now, during periods of inflation, where interest rates are likely to rise, income-focused investments offer stability and a predictable cash flow stream that can help offset the erosion of purchasing power caused by inflation. By maintaining a portfolio that includes a mix of income-producing assets with varying durations, investors can effectively manage risk and navigate through volatile market conditions while preserving their income. So in summary, while growth assets are often touted as inflation hedges, income-focused investments provide a more direct and reliable means to combat inflation through their steady cash flow. Great questions today. Thank you for these awesome questions. And as always, if you would like to send in your question, you can do so. You can email it to us. You can email it to poollocke@poollocke.com. If you like what you heard today, go ahead and like and subscribe to our channel. I'm James Locke, your retirement income source. I'll see everyone next time.
Money on my mind, looking for a dime. James Locke in the house, gonna help you shine. Retirement is near, don't you live in fear. Listen up, my friend, let me make it clear. Savings in the bank.